2008 did not begin with panic. It began with confidence. Housing prices were rising year after year. Banks were eager to lend. Credit was easy, abundant, almost frictionless. Politicians praised a new era of homeownership. Economists spoke about innovation in finance, about risk being spread so widely that it had somehow disappeared. For the average person, everything felt normal, even healthy. If prices kept going up, why question it? But beneath the headlines and optimism, a very small group of people were staring at something deeply unsettling. Not the news, the numbers. The quants were not interested in stories or narratives. They lived inside models. They watched default curves, repayment schedules, interest resets. And the numbers were quietly screaming that the system was lying to itself. Subprime mortgages were not a rounding error. They were a structural flaw. Loans were being issued to people who mathematically could not repay them, even under optimistic assumptions. Adjustable rates were scheduled to jump. Defaults were already baked into the future. This was not speculation. It was arithmetic. Risk had been sliced apart, repackaged, stamped with AAA ratings, and sold as safety. Financial engineering did not eliminate danger. It disguised it. Collapse was never a question of if, only when. Then the delay ended. Bear Stearns collapsed in a matter of days. Lehman Brothers followed, dragging hundreds of billions of toxic assets into the abyss. Credit markets froze almost overnight. Businesses that relied on short-term financing suddenly could not function. Trade stalled, entire industries flatlined, and in that moment the world learned a phrase that would define the next decade. Too big to fail. What followed was unprecedented. Governments and central banks stepped in and did something that would have once been considered unthinkable. They printed trillions of dollars to stabilize the system. Bailouts, emergency lending, quantitative easing, liquidity poured into the financial world at a scale never before attempted. And astonishingly, it worked. Markets stabilized, banks survived. Confidence returned, but the cure came with a cost. Printing money did not resolve the underlying imbalances. It postponed them. Like taking painkillers for a broken bone, the relief was immediate, but the injury remained. Interest rates were crushed towards zero. Debt became cheap. Borrowing was encouraged. Asset prices surged again. And slowly, quietly, a dangerous idea took hold. That money might not have limits. That crises could always be solved with liquidity. That growth could be engineered without consequence. For more than a decade, every shock reinforced the same lesson. When something breaks, we print. When markets wobble, we intervene. When debt grows, we refinance. And each intervention made the system more dependent, more leveraged, and more fragile than before. Today, we are living with the consequences of that lesson, because what we're facing now is not a housing bubble. It is an everything bubble. Stocks are at record highs. Real estate remains far above pre-pandemic levels despite aggressive rate hikes. Gold has pushed to new peaks, crypto has rebounded into the trillions. Artificial intelligence investments are exploding with speculative enthusiasm. Even collectibles, things with no cash flow and no productive value, are selling for absurd prices. Everything is rising at the same time. That is the signature of systemic distortion. This is what happens when liquidity, not productivity, becomes the primary driver of price. When capital chases return simply to escape currency devaluation. When borrowing feels rational because asset prices rise faster than interest costs. Once again, the quants see the pattern forming. Debt is compounding faster than income. Interest expenses are accelerating faster than growth. Liquidity is flooding into increasingly speculative corners of the market, often purchased with leverage. Margin debt is soaring. Risk is being normalized. Fragility is being mistaken for stability. And unlike 2008, this time the exposure is not isolated. Housing is inflated. Stocks are inflated. Bonds are distorted. Crypto is speculative. Art, collectibles, and alternative assets are levitating on the same tide of easy money. Everything is connected. So when markets celebrate all-time highs, understand what that really signals. Not strength, but saturation. Not resilience, but dependence. If you're among the small fraction of people who own the majority of assets, this era feels incredible. Wealth appears to grow effortlessly. Portfolios swell. Optimism feels justified. But for most people, the lived reality tells a different story. If the economy is so strong, why are basic necessities harder to afford? Why are households relying on debt to survive? Why does prosperity feel invisible in daily life while markets cheer endlessly? That contradiction is not accidental. Asset values can rise while purchasing power falls. In fact, they often rise because purchasing power is falling. Yes, asset prices are going up. Supply and demand still apply. Yes, the currency is losing value. Deficits are expanding at a pace that would have been unthinkable a generation ago. Yes, speculation is rampant. Humans are deeply susceptible to financial contagion. We chase what is rising because we fear being left behind. And no, it is not different this time. It is never different. The economy is complex, but it is still a system. And systems obey rules. Money has physics. When you distort it long enough, pressure builds. What we are witnessing now is not normal growth. It is a financial pressure cooker. Cheap money devalues currency. Capital flees into assets. Low rates encourage borrowing. Borrowed money floods markets. Prices rise faster than fundamentals. Stability erodes quietly and visibly until suddenly it does not. And when everything inflates together, everything eventually deflates together. That is why this moment matters. Not because markets are crashing today, but because markets are soaring while the foundations beneath them are weakening. And that is always how the story begins. For most people, economic collapse feels like something emotional. Panic, fear, headlines, chaos. But the truth is far colder than that. Major collapses are not caused by emotion. They're caused by math finally being obeyed. And right now, the math is becoming unavoidable. Since 2020, the United States money supply, known as M2, expanded by more than 40%. That is the fastest expansion in modern history. Roughly 1/4 of all dollars that exist today were created in just the last 5 years. This was not organic growth. It was emergency intervention layered on top of emergency intervention. At the same time, federal debt began compounding at a pace no large economy has ever sustained peacefully. Every 100 days, roughly $1 trillion is added to the deficit, not spent once, added permanently. The national debt now exceeds $37 trillion, an increase of more than 11 trillion since 2020 alone. Debt, however, is not the real problem. Interest is. Interest payments on that debt have now crossed $1.1 trillion per year. That is more than the entire defense budget, more than education, more than infrastructure. It is the price we pay simply to keep the machine running. And this is where the physics of money begins to assert itself. For every 1 percentage point increase in interest rates, annual interest expense rises by roughly $370 billion. That number compounds, it does not reset, it stacks year after year. If average Treasury yields returned to levels that were considered normal before the 2008 crisis, interest costs would exceed $2 trillion annually, roughly half of all tax revenue collected by the federal government. At that point, the math breaks something fundamental. You're no longer funding a society, you're funding debt. Federal deficits are now running above 6% of gross domestic product during peacetime. Historically, numbers like this appear during world wars, deep depressions, or national emergencies, not during economic expansions. Debt to gross domestic product now sits around 122%. Projections show it crossing 130% within a decade. That number is not arbitrary. Across history, that threshold marks the point where countries default, inflate, fracture politically, or collapse outright, sometimes slowly, often violently. Meanwhile, the Federal Reserve sits on a balance sheet exceeding $7 trillion in assets. Those assets were accumulated to stabilize markets during repeated crises. But here is the trap. The Fed cannot sell those assets without collapsing the bond market, and if it keeps printing money to buy more, it risks destroying the currency itself. There is no clean exit. This is what economists mean when they say a system has become mathematically unsustainable. Debt is compounding faster than the income required to service it. Think of it like a flywheel. At first it spins slowly, manageable, then faster still. Each rotation adds more momentum. Eventually the system reaches a speed where no amount of friction can slow it down safely. That is where we are now. And markets, despite appearances, are beginning to sense it. Markets are not rational calculators. They're confidence machines. They function as long as people believe future obligations will be honoured. When belief cracks, liquidity vanishes. We are starting to see the early warning lights. Crypto momentum has stalled. Gold has retreated from its highs. Housing is bending under higher interest rates. Commercial real estate delinquencies are now worse than they were before the 2008 crash. Leverage is everywhere. For the first time in history, margin debt has exceeded $1 trillion. Investors are borrowing at scale to chase returns in an environment already saturated with risk. This brings us to the concept that explains why there is no policy solution left. Fiscal dominance. Fiscal dominance occurs when government debt becomes so large that monetary policy loses its effectiveness. The central bank is no longer free to act. It becomes trapped. Under normal conditions, when bubbles form, the central bank raises interest rates. Borrowing becomes more expensive. Capital flows into safe government debt. Asset prices cool. Stability returns. That lever is broken. If rates rise meaningfully today, interest payments explode. The Treasury must issue even more debt to pay the interest on existing debt. That debt must be financed, which requires higher yields, which raises interest costs further. Raise rates and the government risks default. Lower rates and liquidity floods the system, inflating bubbles further until confidence collapses. Either direction feeds the same fire. This is not a political failure, it is a mathematical one. The central bank can no longer tighten without breaking the government. It can no longer loosen without breaking the currency. The system has reached a dead end, and when systems governed by math reach their limits, they do not slow gently. They fail abruptly. This is why the current bubble cannot inflate forever, not because enthusiasm fades, not because sentiment turns, but because the underlying arithmetic no longer works. The clock is not driven by emotion, it is driven by compounding interest. If the system is mathematically broken, then the final question becomes unavoidable. When does it actually snap? Not eventually, specifically. And the answer is uncomfortable because collapse does not arrive when the numbers first look bad. It arrives when confidence finally runs out. Right now, the United States government is borrowing roughly $50 billion every single week. Not for emergencies, not for wars, just to keep the lights on. In the past 18 months alone, the Treasury issued approximately $2.5 trillion in new debt. That debt was absorbed by a very specific source. Idle cash, money sitting in money market funds parked there during years of quantitative easing and low rates, waiting for yield. When Treasury yields rose, that cash rushed in. It became the buyer of last resort. That pool is now almost empty, but the borrowing has not slowed, it has accelerated. This year alone, the Treasury is on pace to issue close to $3 trillion in new debt, the largest peacetime borrowing spree in American history. This time, there is no mountain of excess cash waiting to absorb it, which means new buyers must be found, and buyers only appear when yields rise. But higher yields do not exist in a vacuum. Higher yields pull liquidity out of banks, out of equities, out of housing, and out of every risk asset that has been floating on cheap money. They expose leverage, they stress balance sheets, they break weak structures, and as we already established, the system cannot tolerate that stress. So we reach a strange place. The government must borrow more, the market demands higher yields destabilize everything. At that point, the constraint is no longer interest rates or liquidity, it is belief. Credit only exists if lenders believe they will be repaid. Markets can absorb bad news, bad data, even bad policy. What they cannot absorb is disbelief. When investors begin to doubt that the Treasury, the Federal Reserve, or the currency itself can manage this debt without destroying purchasing power, lending does not slow, it stops. And when it stops, it does not stop gradually, it freezes. A failed Treasury auction would be one possible trigger. That is when buyers simply refuse to purchase new government debt without dramatically higher yields. It is not a technical glitch, it is a statement of lost confidence. Historically, moments like that mark regime change. The Nixon gold shock was one, this would be another. A credit market seizure could do it as well. Repo markets are the plumbing of the financial system. They operate on trust in collateral. When that trust erodes, liquidity disappears in hours. Banks stop lending, markets seize. Inflation returning aggressively could be another catalyst. If prices spike again, the central bank would be forced to tighten into a weakening economy. Defaults would cascade across households, corporations, and governments simultaneously. In every case, the decision tree collapses into the same impossible choice. Protect the currency or protect the system. You cannot do both. This is what Ray Dalio calls an ugly deleveraging. Debt does not get politely paid down, it gets restructured under pressure, wealth is destroyed, assets reprice violently, social and political stability fractures. History gives us a disturbing pattern here. When interest payments begin consuming more public resources than defense, infrastructure, or healthcare, politics becomes zero-sum. Every election becomes a fight over a shrinking pie. Compromise disappears, institutions weaken. Once debt crosses roughly 130% of gross domestic product, societies tend to break. Through default, through inflation, through unrest, through revolution. The United States is already past 120%. Confidence is the final dam holding everything back, and dams do not fail slowly. They fail all at once. No one can tell you the exact date. Markets are too complex for that. Anyone claiming certainty is lying or selling something. But the math gives us a boundary. The longer this continues, the more violent the reset becomes. Because compounding does not pause, it accelerates. When systems reset, most people think in terms of destruction. But history tells a colder truth. Every collapse is also a transfer of wealth. Money does not disappear. It moves from the leveraged to the liquid, from the impatient to the patient, from those forced to sell to those who are able to wait. So the real question is not whether the system resets, it is whether you are positioned to endure it. The first and most important rule is humility. Do not try to outsmart the market. Do not believe you can time the collapse. Even the most famous investors in history have been wrong far more often than they have been right. People like Michael Burry or Peter Schiff are remembered not because they are always correct, but because they were correct once, at exactly the right moment. You can be directionally right and still be destroyed by timing. And if you're leveraged, timing mistakes are fatal. That is why discipline beats brilliance. The most successful long-term investors do not attempt prophecy. They build systems that survive uncertainty. Ray Dalio does not bet on one future. He prepares for many. Warren Buffett does not chase momentum. He waits, holds liquidity, and moves only when price and value align. Their advantage is not intelligence. It is restraint. In periods of fiscal dominance, liquidity is oxygen. Debt offers leverage, but it also hands control of your survival to the calendar. The levered always die first. This is not ideology, it is arithmetic. That is why diversification across uncorrelated assets matters, not because it maximizes returns, but because it minimizes ruin. In a systemic reset, avoiding ruin is everything. Focus on fundamentals, assets that generate real cash flow, businesses that can survive funding stress, structures that do not rely on endlessly cheap credit to exist, and most importantly, build rules. Do not rely on conviction. Conviction feels strong right before it breaks. Rules endure when emotions fail. There is a modern framework that fits this era particularly well. It comes from the work of Lynn Alden, who analyzes markets through the lens of long-term debt cycles and fiscal dominance. Her approach rests on 3 pillars. The first pillar is profitable growth equities. Real businesses with pricing power, strong margins, and the ability to adapt when capital tightens. Not hype, not stories, cash flow. The second pillar is defensive liquidity. Cash and short-duration instruments, assets that preserve optionality. In a crisis, liquidity is not wasted capital. It is the ability to act while others are frozen. The third pillar is inflation protection. Commodities, energy, precious metals, hard assets, and cautiously alternative monetary systems that exist outside traditional debt structures. These hedge against currency debasement when policy loses credibility. The exact allocation will vary. The philosophy does not. You do not beat a debt cycle with clever trades. You survive it by respecting the math and preparing for uncertainty. What should be avoided matters just as much. Avoid all in all-out decisions driven by headlines. Avoid chasing yield in fragile assets. Avoid margin. Avoid assuming that markets must always go up. And above all, never say the phrase, "this time it is different." Math does not care. It never has. What is happening now is not about fear. It is about physics. For decades, we acted as though money could be printed without consequence, as though debt could grow without limit, as though compounding interest could be ignored indefinitely. But compounding interest is always the final boss. You cannot print real prosperity. You can only borrow it from the future, and the future always arrives carrying the bill. When confidence finally breaks, the reset will not be polite. It will not give warnings, it will arrive like a flash flood. So plan now. Build resilience now. Because when the flood comes, only those already on the ark will still be standing.